The gap between return on capital and cost of capital is cash flow. Half of that cash flow typically gets returned to shareholders as a dividend. The other half of the cash flow is reinvested back in the business, which in turn fuels earnings growth.
So most investors, do not make great returns in equity markets, because they get trapped either in greed or in fear. So out of fear, investors do not enter into equity markets when the levels are low, and out of greed, they start trading. They get into mid caps. They don't understand the companies they're investing into. But fundamentals, prove, there are data points which prove that there are, more than 15 companies which have been delivering more than 20% return on equity for last 10-20 years. Investors who have invested money in them, maybe again out of greed and fear, booked profits early, but there are very rare investors who would have remained invested and who would have built wealth. These companies are called money making machines. These companies are called consistent compounders. So today we have amongst us one of the fund managers from equity markets who believes very, very convincingly about this philosophy and who has created his company by name Marcellus Investment Advisors, and he is the portfolio manager there. I welcome Mr. SAURABH Mukherjea with us.
Thanks.
So over to you, SAURABH. I would first want to understand from you, what is your perspective about the overall universe of the listed space?
Right.
Why, amongst the listed space, you want to focus only on these quality, maybe 10-15 companies?
Sure. So look at this. I think our country has a large stock market. As you know, there's 6,000 companies listed in our country. But if you look at India, nearly 90% of the listed companies have no ability to grow their earnings, grow their business. They don't really have any sort of competitive advantage. The return on capital is broadly the same as the cost of capital. Sometimes the return on capital is consistently below their cost of capital. In fact, many businesses in the Nifty fall in this category. This is, I would call them type A companies. 90% of the market is like this. No growth in earnings, no ability to grow the business at all. And many prominent firms that you and I know fall in this category. In the second category, type B, is around 9% of the Indian market. These are better companies. They have some comparative advantage. Their return on capital is somewhat above their cost of capital, and therefore, say over a 10-year period, their profits grow at around 12-13%, right? So, prominent companies such as say Maruti Suzuki, such as Unilever, will fall in this category. Decent companies, 12-13% growth over a decade. If you get really lucky with the PE, you might even make 17-18% returns with such companies, right? 99% of companies therefore are falling in type A and type B combined. Okay. Now, if you look at a market like the United States, that would be the stock market in America in totality. Someone like Warren Buffett, his career has been spent investing in type B companies, Unilever, Maruti, equivalents for the United States market.
Right.
Where the Indian market is unique, right, and we are the only large economy in the world to have this, is we have a third category called type C. This is roughly 1% of companies in the Indian market, and they're unique in the sense that their return on capital is significantly above their cost of capital for many decades on end. Right? I've described these companies in my book, Coffee Can Investing. These companies, the inspiration came from a man called Rob Kirby. He had written a paper in 1984 called Coffee Can Investing, and I took that as the foundation for this idea. But the interesting thing about our country is, in pretty much sector after sector, we found one or two such companies, right, where the return on capital is significantly above the cost of capital for decades on end. And if you invest in these companies and stay invested, you get what we call as the consistent compounder portfolio, right? These are companies who over a 10-year period consistently give you a return on capital well above the cost of capital. They give you revenue growth, which is in double digits, 10 years in a row. And typically, as I've shown in my books, if you invest in such companies over long periods of time, you get compounding, which is in the low 20s. So not only do you get the compounding is in a way important, but not the be all and end all. The volatility of your returns is very low. The volatility of your returns is almost comparable to a government bond. So the main driver of prosperity of stock investing in India is not the type A firms, which there's no profit growth, how can we ever get it prosperous? They're not even type B firms, which is well-known firms, very well-known firms, blue chip firms as they are called, fall in type B. The main driver of long-term compounding at lower levels of risk is type C firms. The consistent compounders, as I stress again, these are unique to India, and no other large stock market in the world will you find this. If you look at markets like say UK, USA, Japan, France, America, you won't find companies whose return on capital is massively above their cost of capital for decades on end. Think of global giants like Toyota, Daimler Chrysler, Walmart, JP Morgan, Morgan Stanley. None of these firms have return on capital massively above the cost of capital. Think of our country, very quickly you and I can discuss 15-20 names where return on capital is massively above cost of capital. The gap between return on capital and cost of capital is cash flow. Half of that cash flow typically gets returned to shareholders as a dividend. The other half of the cash flow is reinvested back in the business, which in turn fuels earnings growth. So you're getting earnings growth which is 20-25%. You're getting very high cash flow. As a result, consistently getting good returns. The basis of my career in India has been that, and as we were discussing, Marcellus Investment Managers' consistent compounder portfolio is based on that premise.
Okay. So, can you please explain with a few examples of these companies, maybe, explaining the business models, then how you call them as money-making machines,
right.
And, how can an investor believe that they will continue to remain money-making machines?
Let's take the simplest example possible. Let's take Nestle. The majority of their profits come from selling baby milk powder.
Okay.
These are say brands like Nan 1, Nan 2, Cerelac. Now our estimation is in the baby milk powder business, we estimate Nestle to be generating return on capital employed in the vicinity of say 75%, i.e. it's very, 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 very profitable. Right? So if you assume cost of capital is roughly 15%, the gap between 75 and 15, the gap is mountains of cash flow, like a cash machine. Now why doesn't somebody else enter the baby milk powder business and undercut Nestle by 20-30% and take away their profits? Why doesn't somebody do to Nestle what Jio did to the other telcos in India? So initially, we were very perplexed. We were asking ourselves, why don't we see new entries from other FMCG giants in India? But as we dug into the matter, we realized that it's illegal to advertise baby milk powder in India. Just like alcohol, you can't advertise baby milk powder. So the implication of that is if you can't advertise the product, no point discounting it, because if you can't tell people about the discount, how will you ever make money from it? And in fact, Kamal, as we dug even deeper, we realized that both for baby milk powder and for Cerelac, you need a license from the drug regulator. Over the last decade or so, the drug regulator has not given anybody a license to sell baby milk powder. Right?
Drug regulator based out of?
The pharma regulator based out of Delhi. Right? The pharma regulator hasn't given a license to anybody to sell either baby milk powder or even Cerelac. Right?
Okay.
So Nestle therefore is protected through two layers of regulatory protection. One is you can't get a license. Second is even if you could get a license, what will you do with it? How will you tell the public about your product? So behind this fortress of protection, Nestle is earning 75% ROC. They're churning out massive amounts of cash, and therefore this is the closest example I can give to you and your clients of a perfect ATM machine in the real world. This ATM machine is chugging out not just 2,000 rupee notes, it's chugging out thousands of crores. And all you and I have to do is stand in front of it and hoover up the cash rather than running around the block helplessly going to other ATM machines, right? So that's the simplest example of a consistent compounder. Now, somebody who's watching the program will say, well, this is a good example, but it's premised on regulation, right? So if you want to think of a consistent compounder where the moat, where the protection around the business is equally strong, but the competitive advantage is not premised on regulation, we can discuss, say, Asian Paints. So if you read my book, Unusual Designers, you'll see in that book I've described that over the last 60 years, over the last 6 decades, Asian Paints has grown revenues at around 20% every single decade. In fact, for the last 5 decades, the profit margins are rising. For the last 3 decades, return on capital employed is rising for Asian Paints, right? stock is up some 1600x since IPO in 1983 and up in a pretty smooth line. Now the question is, why does Asian Paints make so much money? This is one of India's greatest wealth engines ever seen in the Indian market. The promoter families themselves are worth more than $10 billion. Minority shareholders are worth more than $5-6 billion. This is an enormous source of education. But why does Asian Paints generate so much wealth? So initially when I look at this stock in 2012, 2013, 2014, I used to think the quality of the paint must be very good. But over the years I've realized that's not the case. I've met lots of people, I've spent time with 60, 70 paint dealers, I've met retired CEOs of most of the large paint companies. And what I've realized, Asian Paints' paint is not the best paint. In fact, you could argue, and many would say, AkzoNobel arguably has the best paint brands in India in terms of quality of the product. Yet Asian Paints is the paint company which makes money hand over fist. Why does it do that?
Yeah.
Right? So we dug into the subject over it took us the best part of 2 years to figure this out. And what we figured out was that what Asian Paints did 50 years ago was they restructured their entire supply chain. They got rid of their distributors and their wholesalers. They ripped out the margin that was getting to the distributors and wholesalers. They went direct to the dealer. They set up a very sophisticated supply chain which delivers directly to 40,000 odd dealers 4 times a day. And to do all this, back in 1970, they installed a mainframe computer system, the first of its kind in India after the weather forecasting department's mainframe computer. And Kamal, what Asian Paints has done, which is its sort of secret weapon, its competitive advantage, I would suggest, is over the last 50 years, in every neighborhood of India, for every hour of the day, every day of the year, Asian Paints has collected proprietary data on paint demand. Okay. Right? So sitting today in their headquarters in Mumbai, they know that 10 days hence, in say South Delhi or a specific corner of South Delhi at 7 p.m. in the evening, this is the paint demand in terms of quantities, colors, tin sizes, etc. Right? They know 10 days hence at 7 p.m. in the evening what's the paint demand in say Jayanagar in Bangalore, Egmore in Chennai, Godiahat in Kolkata, wherever, across 30,000-40,000 locations, right? Basis that proprietary demand, basis the proprietary demand data that they have, basis the proprietary algos, their supply chain will deliver paint 10 days hence, entirely based on an automated system. All that the dealer in specific part of South Delhi has to do is offload the paint from the delivery truck, keep it in the shop for 3 hours, it will sell. 3 hours later, the next truck comes, it will sell, and so on and so forth. 10 days prior, the relevant factory in the relevant part of the country will get an automated instruction about the production schedule. The production manager doesn't have to use some huge judgment. The dealer doesn't have to use a huge judgment. The whole thing is automated based on proprietary data. And this system is so precise, it's so well drilled, that Asian Paints' working capital cycle, i.e. the time it takes for them to convert chemical into cash in their bank account, that cycle is barely 8 days. Now, for the other paint companies, and many of them are high quality companies, the similar cycle is 30-40 days, right? 3 times, 4 times as long. Not only is the cycle longer, Asian Paints can now go to the dealer in say a specific part of South Delhi and say, look, I send you 4 trucks a day, the other paint companies send you 1 or 2 trucks. So if they pay you 5 rupees a litre as a dealer margin, I will pay you 3 rupees a litre. And most dealers I've spoken to Kamal, they're very happy with that deal. They get paid 3 rupees for holding the paint in their shop for a couple of hours. Right. That's pretty much it, right? So the result of this, very low dealer margins, very crunched working capital cycle, the result of this cover is that Asian Paints is obscenely profitable, very high ROCs. That in turn takes away the need to hike prices. So if you look at Asian Paints over 10 years, 20 years, 40 years, whatever horizon you take, the average annual price hike is 2%. And that is incredibly damaging for the competition. The competition's labor costs are rising, land costs are rising. They need to hike prices by far more. Right? But because Asian Paints isn't doing it, the competition can't do it. Asian Paints, after all, is 50-55% market share. So the competition basically gradually exits the market. Right? You look at Sherwin-Williams, they left India in 2011. So you end up in an industry which is dominated by one player. Berger is the only other credible player in the sector. 2-player sector. Both players earning return on capital massively above the cost of capital. Both players are cash machines. Revenue growth for both of them is in double digits, pretty much 9 out of 10 years, and you therefore have consistent compounders here as well.
So, one subsequent question that immediately comes to my mind is that in general, whenever anybody takes a call to do an investment, right, he would want to know, whether he's investing maybe at the right time or the wrong time in terms of valuation. Right? So, seeing the history of 10, 20, 30, 40 years, where, investors maybe would have seen that these stocks have been rising consistently. So, if one enters now, in general, investors fear that maybe they're entering at a wrong time. So, I agree with you that the belief which you have, in your mind is that this story is going to continue, right? Because these companies cannot be disrupted. These companies have shown endurance in the past. They have nothing to do with changing government, changing policy, right? They are great entry barriers, right? But valuations are definitely expensive. So, what is your argument?
So let's use that type A, type B, type C structure at UV. So let's look at type A companies, 0% earnings growth, nothing special in the franchise. And therefore the only way you can make money from type A companies is the PE multiple expands, right? You're a clever man, you'll probably find a superstar fund manager in Bombay who will enter a type A stock at 10 times PE, exit at 20 times PE, and that means this on PE compounding, on PE rising, the stock will give around 7% return over 10 years, right? If your chosen fund manager is unlucky in terms of PE timing, it will be -7. So overall returns from type A stocks tend to be +7 or -7. Nothing is neither is particularly impressive, but the whole thing is a PE driven story. Let's go to type B. Stocks we're discussing is in Maruti, Unilever type category, good companies. Here the earnings compounding is around 12-13%. If your superstar fund manager enters the stock at 12 PE and exits at 24 PE, that will be the PE will add another 7% compounding over 10 years. 12 plus 7, 19% return from type B. It's a good outcome. And if your chosen fund manager is a little unlucky, the PE could go from 24 to 12. That's -7%. 12 minus 7%. That's only 5% return. A little unlucky. But at least in type B stocks, it is possible for you to get a high PE return. If alongside the earnings growth, you get a little lucky with the PE, right? The world we are focusing on, Kamal, is type C. The consistent compounders is the top 1% of corporate life in India, right? In the sorts of companies we are focusing on, the companies we just discussed, the earnings compounding is in the vicinity of 25%, right? Now, if we get lucky in inverted commas with the PE, our earnings growth will be 25%. The PE will add another 7% to it, 32. There's around 2% dividend yield in these stocks because they have so much cash. So you'll make 32-33% return. Your client will be very happy. But let's assume, as you rightly said, PE multiples are high. So maybe over the next decade, PE multiples come off. Right? So with the sorts of companies we're discussing, if the PE multiple halves, 25% is earnings growth, minus 7% for the PE multiple halving, 18, plus 2% for the dividend, 20%. So even in a scenario with PE multiples halving, the sorts of companies we are choosing are going to give you return in the late teens, low 20s. And that's why the book that we published last year is called Coffee Can Investing, called the low risk route to stupendous returns. The low risk is coming from the strength of the earnings engine. Right? And the earnings engine in turn is strong because the franchise is protected by walls. In Nestle's case, the wall was regulation. In Asian Paints' case, the wall is proprietary data and a unique supply chain logistics. Right? Inside that wall is a large sector, baby powder paints, where demand is pretty much a given. It doesn't matter who's the Prime Minister, who's the RBI governor, whatever is the American president saying. You're going to buy baby milk, you're going to buy paint, you're going to buy hair oil. So the demand is a given. Inside the protected wall, these companies are compounding earnings at 20-25%. And that's where the low risk comes from.
So, this is quite insightful, and one needs to just have conviction and hold on to these stocks for a longer period of time. And more you hold, more wealth you generate. Generally, people believe that equity markets are to be timed. One has to maybe enter low. Right? Every time is not right time to invest. So,
Yeah.
given this philosophy, I think all these are myths. One should, I think, only enter into these quality top 1% businesses and then just hold them for as long as they want.
Yeah.
Now, if it is so simple, then why would anybody pay a fund manager
Yeah.
like you, right, to manage their wealth? Why won't they, just identify these companies and invest on their own?
Yeah. So to be honest, most people I meet, I tell them that you don't need to see me ever again, right? You shouldn't ever have to see me again for your wealth.
You have to be too modest.
The books are available on online. Both the books are bestsellers. They barely cost 200 rupees, courtesy the generosity of the websites and giving discounts. So honestly speaking, I'm not making it up. Either your clients by themselves or with a bit of assistance from you, they can do this themselves. They don't need to see me or my colleagues. They can make money themselves, and that's why we wrote the books. We want people to read the books, make money themselves. There's only so many people we can look after, and there are far many more people who need their money looked after than we can possibly service. Now, what value do we add? Even without meeting me, if you read my books and do what the books say, you get around 21%. If you're a little lucky, perhaps 22% return. The only thing I can do for you is perhaps improve that number by a few percentage points by doing a couple of things. Firstly, the book is obviously, deliberately the book is built like a robot. Right? In the book we say you have to have 10% revenue growth consecutively in 10 years, and you have to have 15% ROC every single year for 10 years. We're not forgiving in the book. So if you miss 1 year, we throw you out. So had we gone literally by our own book, we would have sold Nestle. We did our work, my colleagues did their work, and we figured out that there's nothing fundamentally wrong with the firm. Yes, it will miss the revenue threshold this year, but this is a non-recurring event. We held on. The company's vindicated our faith. It remains a formidable franchise and it continues compounding at a phenomenal rate. Right? So step one, where we deviate a little bit from the book, is we use our judgment, our research to forgive companies who might have missed for reasons which are exogenous to the business and reasons which are non-recurring. The second deviance between us, our way of investing, and the book is there are some companies who pass the filter. Right? They do double digit and return on capital above cost of capital 10 years in a row. But once we do our diligence, we realize these companies don't have any deep competitive advantage. So the way we think about it is, if a new player were to enter their sector and offer the same product 20% cheaper, the company would have to cut its prices to deal with the competition. But as soon as it cuts its prices, its profit margin, its ROC will get pulverized. Right? And hence, after doing that work, we stay away. So although the filter allows say 15 stocks to come through, our portfolio only has 11-12 stocks in it because of these two value adds, right? These two interventions. Right? So think of the investment methodology as given in the book as the Lakshman Rekha. Right? Rob Kirby's 1984 paper gives us the Lakshman Rekha. Our job is to work within the Lakshman Rekha and make some judgment calls which improve your client's return by a few percentage points. But as we were discussing a minute ago, if they buy the book and they do what the book says, you have them do what the book says, they don't have to ever see us. There's a great wealth to be created even without our intervention. If you involve us, we add a few percentage points.
Sure. Another thing, regarding your fee structure. So, as I got to know that you have the fixed fee, but you also have a variable fee option. And I think you are amongst very rare firms in the PMS industry who do not charge any fee up till a very high hurdle rate. So, what convinces you, to introduce such kind of aggressive client-centric pricing, which is from an advisor's perspective very, very right, but how do you make money out of it?
So look, I think we all have to realize that there's no shortcuts to wealth creation, either for your clients or for you or for us. We're not going to suddenly get rich by being greedy, right? This is a profession where trust is central. The credibility and trust are very strongly correlated. You also have to realize that with this profession, the investment management profession in India doesn't exactly enjoy the greatest of reputations in terms of its focus on long-term alignment with clients' interests. So keeping all of that in mind, and I also do a fair bit of work for the Indian regulator in terms of guiding the regulator on where the industry should be going. I write a fair bit in the financial press and in my books about where I think the investment management profession should be going. So keeping all of that in mind, we felt it was only fair that we launch a product which has no fixed fees, no entry load, no exit load. We make money if the investor makes money. SEBI very cleverly put a high water mark for all performance fee based reviews. So we only charge a fee A when the high water mark is reached, i.e. your portfolio is at a record value, and B we charge performance fees after your hurdle rate is met. So you only pay us when two conditions are met: the portfolio is at a record value, high water mark met, and secondly when the year-on-year hurdle rate is met. Two separate criteria to meet. What that gives you is, I think what it gives your clients, Kamal, is that they get a great deal of reassurance that these people at Marcellus are not going to make any money unless I make money. And secondly, on the same dollar of return, Marcellus will not make money twice because of the way the fee structure is created. We're doing it because we have a long-term interest. We have an interest in building a healthy franchise in the long run. We're doing it because we are in no rush to suddenly come here and make money overnight. We've built an investment philosophy which we think works. We built an investment philosophy which allows your clients to patiently accumulate stupendous wealth in our country. As your clients get rich, we will benefit from it in the long run, and we happen to be patient.
And you are one of the rare fund managers I would have come across who are so clear about what they are doing. Who not only just talk about quality investing, you're actually restricting yourself to top 1% in terms of your investment philosophy, and given your aggressive fee structure, it's phenomenal. It's very client centric.
So kind of to say that, but I think one of the reasons we can afford to do it, in all fairness, is we're not looking to build a giant fund house. If I was trying to build a fund house with tens of thousands of crores of AUM, I would have to go into not just the type C stocks, which is our focus, the top 1%. I would have to do type B as well, which is the good companies but not great companies.
Right.
As soon as you go into type B, you drag the returns down to 12%, right? Which becomes dicey territory because for many of your clients, the cost of capital itself is 13-14%. Right? I think that's the tension in investment life. Once you have a big economy, $3 trillion economy, our pool of high quality stocks is pretty limited, 20, maybe 30 names in our country. We believe that it's sufficient for us to fish there because we are a small group of people focused on building a high quality boutique investment management business. Obviously, if I was intent on building a fund house with thousands of crores of AUM, I would have to think about investing in a very different way.
You said that you are part of the regulatory body, working with SEBI also as a pro bono, and you raised this very pertinent point that you are not wanting to set up a huge AUM, designing firm. What is your view otherwise, with regards to the wealth management industry's future? Are more and more boutique wealth management firms who will come with philosophy like you, that they want to just focus on few clients, want to just focus on advisory and consulting model, right? Are they going to take away share from the big names like IFL, Kotak, and other private banking arms? What is your perspective?
So I think there'll be more than enough room for everybody. What's going to happen, and you can see already happening, over the next years, two different trends are playing out. One is amongst affluent Indian families, there is obviously a natural shift away from physical assets, primarily real estate, which is a abiding obsession for affluent families in our country. They've realized that real estate is a dead end, and as they reallocate wealth from physical to financial assets, PMS AIF asset classes is benefiting. So is mutual fund, but then PMS AIF are disproportionate beneficiaries. So the shift one is affluent families realizing that this whole obsession with buying gold and real estate is a complete dead end, and therefore reallocating to financial assets, and the wealth advisors, both large and small, benefit from that. The second trend in our country is people who began their working lives in the mid 80s, early 90s, right? They're approaching retirement over the next 10 years. Right? Many of them have obviously done well as the Indian economy has boomed in the last 50 years or so. But a lot of these people, although they're only 10 years away from retirement, are nowhere near building a satisfactory retirement corpus. As executives realize, as professionals realize that the clock is ticking down on their careers and they need to save properly for 10 years, there will be a strong demand for services from wealth advisors. So two different sources of demand: the professional class saving for retirement, and the promoter class realizing that if they want to grow their wealth, they can't be invested in land and flats and gold. They've got to look at financial assets.
Thank you so much.
Okay, thank you. Thanks,
for having you here.
Thanks
It
for
has
your
been a pleasure talking to
thanks
you.
for this opportunity.